Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Thursday, the 22nd of June, Bull versus Bear webinar. In here, Steve Miley on the call in here for Trade Day. Welcome, everyone. Good morning. Quick slurp of my drink there before I get going. So, let's run through all the macro fundamental geopolitical events that we've got impacting markets right now. And first of all, before I do that, just to share, this went up this morning. I put this up in this morning, an article we've written on the US futures market and Powell from yesterday, obviously speaking again today. Rinse and repeat from Powell. Is the whole going to be a continuing pause? Cautious market could continue. Looking at the futures markets in here. So take a look at that one. There is the link. I've also put it into the in the trading room. You can download it here if you want to download it as a PDF. So you've also got the option with that as well. So take a look at that. It's in the trading room. I put it in the forums. It's in the heads up. No, it's not in the heads up. It's in the forums. It's in the trading room where we have our fundamentals. I can't go in there and show you because obviously that's where this streams and you're sitting in that room anyway. So you should be able to see it under the technical and the fundamental. Under the fundamental, it's the latest one. It's also been posted in the forums and you can get it on the trading advice in here. This is going to be changed to blog soon. So trading advice link in here on tradeday.com. So you can find it there as well. So just if you're interested, go take a look at that. That's just out, just been published this morning. So let's take a look back and look forward. So yesterday, obviously, Powell. I'll come to Powell shortly, but Powell was the real main focus yesterday. We did have a few speakers in here. I'll come to Bostic spoke this morning as well, I think it was. So we'll come back to that shortly. Powell, but then going and looking into today. The focus today was then on two central banks this morning. Obviously, we've got Powell again this afternoon. Probably not going to get too much more from Powell. We didn't get a lot really yesterday, okay, because he obviously only spoke last week. We didn't get a lot from Powell yesterday. Probably not too much more going into today. What we did get though is an interest rate rise from the SNB, the Swiss National Bank, as anticipated of 25 basis points, 1.75%. So we got that from the SNB, the Swiss National Bank. But probably more significantly, probably where the interest was more lying in here, the Bank of England, after that super hot inflation report that we had on Wednesday. I'll talk a little bit more about that. Did kind of dwell on that yesterday. Did say to watch out for this today, right? And there was a potential for them to do a bigger hike, and we got that, right? So 450 was previous. The hike was expected to 475, but then there was a lot of talk of maybe a bigger rate hike because of that hot inflation data that we saw out of the UK on Wednesday, and we got that bigger hike today. So the Bank of England raising rates to 5%, and then also indicating they've got a lot more to go in here. So real concerns in here that rates are going to go through 6%. Mortgage rates are already, the fixed rate mortgages, now we have shorter fixed rate mortgages of 2 and 5 year, they're already topping 6% in here in the UK. It's going to have a real significant impact. Very likely that it's going to slow the economy aggressively as they have all these these people with mortgages remortgaging at these much higher rates than maybe they did 1, 2, 3, 4, 5 years ago. So that's going to have a real significant impact. Will slow the economy down, likely tip the economy into recession, to be quite frank. And the UK battling like a real battle against super high inflation, right? Go back to the data. We looked at this in depth yesterday, right? We hit the core CPI data is sitting at 7.1%, and then the main headline data 8.7, unchanged. You're expected to drop 8.7%, another 0.7% on the month in here. So still super high compared to the rest of the major global economies, way the highest within G7. And the Bank of England reacting to that this morning with that much more aggressive rate hike. Looking into the rest of the day, I'm going to talk a bit about that as we go forward. We do get some Fed speakers today, Bowman, Mester, and I think there's another one further out. where are we? Yeah, Barkin in here speaking today. So we get various Fed speakers in here today. The focus really back on Powell, who goes to the Senate now. It's the same testimony. So you're going to get the same script. Okay, so nothing new on there. It's whether the Q&A brings up anything new. Okay, it may do. Who knows, right? They may ask him something about the Bank of England, right? That they've gone 50. Who knows, right? We may get something more from Powell at 10 o'clock this morning Eastern time. So watching out for that. But it's doubtful, right? He spoke last week. He spoke again. But this more hawkish tone, the hike by the SMB, which was expected, but they were a little bit hawkish in here. Okay, the SMB stayed hawkish. That was potentially going to be the terminal rate, the highest rate. Okay, the peaking rates, and they've kind of indicated that they could easily go higher as well. And obviously, the Bank of England not only more hawkish with the actual rate hike, but also signalling and potentially more to come. This is pointing to us to, what Powell was trying to say, higher for longer, okay? And they're really trying to ram that home. The market is kind of trying to ignore it, right? But unfortunately, they're saying higher for longer. Rates could go a lot higher in the US. We could start to see an uptick. We're certainly not seeing inflation rates coming down in the UK. UK is a little bit in particular. It's got a few things going on. It's got the aftermath of Brexit. It's got its own peculiarities with respect to food prices and, coming out of Europe and regarding Brexit as well. It's got its own peculiarities around energy prices. It's got, still, higher public wage demands coming from the public sector with lots of strikes going on in the UK throughout this year. So it does have its own peculiarities, which has made inflation particularly sticky. But we've seen this from all the other central banks. I've been barking on about this. The Bank of Canada talking about, unusually stubborn, that's the word they're using, kind of stubbornly high inflation, sticky inflation, right? It's not coming down like it should do. Like we got kind of an indication, remember, we haven't been in high inflation environments for decades, right? So the data is all very old. The world is very, very different. But the macroeconomic data, we're not seeing the response to these, what has been very aggressive interest rates, across all the major central banks over the last 18 months. We're not quite getting the response and the lower inflation that we expected. The jobs markets are staying resilient until the jobs markets start getting wobbly. I kind of went on about this, a few webinars ago. People only stop spending when they feel that not either their job is at risk, or if they lose their job, will they be able to get another one? And at the moment, the job market is very, very, very tight. There's there's an abundance of jobs, right? Generally speaking, across the globe. Okay, so that just means that people feel that they have confidence, even if they lost their job, they could get another one fairly easy, and they can switch between jobs. And all of this means that spending patterns are not coming down as much as we thought. Okay, despite these higher interest rates, people may be just going into more debt because they're confident they're going to keep their job. When they're not confident whether they're going to keep their job, or they might be able to not get another one, then they don't necessarily go into debt, right? So then we're seeing this kind of this sticky, this stubborn inflation, and that's particularly being seen in the UK. But I just want to stress, right, the BOC, the Bank of Canada, this is what Powell's trying to say, right? We might need to go higher for longer. And the US, even though inflation rates are coming down fairly aggressively in the US, we could easily see them bottom out at these levels, and it's too high for them to bottom out, or they could start ticking higher again. We've got this whole thing with El Nino as well, potentially putting on inflationary pressures. So there's a lot of question marks out there, and we're at this real cusp. Are we at a pause? Are we at a turning point? Are we going to reintroduce further rate hikes, and not just the US, all the other major central banks? Okay, are we going to have to take rates a lot higher? Are they going to stick there a lot higher? Are we going to dip into recession or not? Right? Up until now, it's been fairly clear: higher interest rates, we may go into recession or not. Now it's like, well, are we actually in recession? In Germany, yes. In the EU, yes. In New Zealand, yes. Okay. Are we going to see that in the other major global economies, or are we not going to go into recession? So markets are really, and we're seeing it in the last few days in here. Markets starting to listen to this a little bit more, and having been very overbought and it's stretched on the equities, particularly in the US, we're starting to see some significant setbacks in here from Friday through Tuesday, Wednesday as well. So we'll take a look at all of that. Let's run through some of the articles in here. So Bank of England steps up inflation rate with shock. It wasn't a massive shock after the data in here. 7-2 vote in here. Markets are priced in only a 40% chance of a rate hike, even after the inflation numbers. So the market's really reacting to that higher inflation numbers in here. And here you can see that UK has higher inflation than its major peers. Look where it is compared to the US. US rates, US in here 4%, UK still at 8.7, Euro area 6.1. So it's still stubbornly high. Look where we were in here now. So at this point in here, in, I don't know, where was this, as we were hitting kind of peak rates or getting towards peak rates in the early 2022, yeah, then the US has been falling since then. Europe went a little bit high and then have been falling aggressively. Look at the UK, is the black line, right? Just continued to go up, 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 and has hardly come down. Look at the difference to the yellow line, the US, okay, and the pink line, the EU, okay, the Euro area. And then look at this. We've broken above this this 2-year fixed rate and 5-year fixed rates mortgage. 2-year fixed rates mortgage breaking above 6%. Right, real concerns in here. And this was the mini crisis we had last year with the abomination of rates leaping higher because of Liz Truss's budget crisis, but creeping up back to that spike in rates we saw back then last year. So real concerns above 6% on the 2 years is going to really choke off demand. So this was an article actually from before. BOE hikes seen as certain after inflation, and this was a guide on the decision in here. And look, peak rates now looking at 6%, but maybe they're going to go even higher now. This was before today's decision. Okay, we were looking at peak rates. So this is not the mortgage rates. This is the base rate. Okay, so if these go to 6%, mortgage rates could easily get up to 7%. 2-year and 5-year mortgage rates could maybe get up to 7%. And I've got a couple of articles in here. These were both written before. I'm going to share these in here on like sister site. This is a site that I own as well. In here, will the Bank of England increase the base rate to 7%? Maybe we're going that high. Okay, so that's what the commentators are starting to talk about. This from Charles Archer. So yeah, I mean, a lot of focus on the Bank of England today in here. Bank of England hike rate to 5% in surprise move to tackle stubborn inflation from Reuters, and another one from Bloomberg in here. Bank of England step up inflation rate with shock rate to 5%. 5 things to start your day. So this was out before that the interest rate hike. But Powell in this, talking about higher for longer. It's not done raising rates. We're going to go higher again in here. So and then Bostic as well. Now Bostic is a dove, right? He supports holding the central bank's target level for the rest of 2023. Okay, so that was from Bostic in here. Powell defies critics and makes case for why rates must rise. And Bostic in here. Saying letting restrictive policy work while it's prudent, he says. Inflation slows, real rates rises, so policy becomes tighter. So Bostic is a dove in here, right? If you go and look at FOMC Hawk Dove sheet, which is available on that in the blog area in here. You can get that on from Trade Day. And you see in here, Bostic. Actually, I've got him in the middle. Bostic is more of a dove, right? He's more of a dove than that. This does come from ITC, but Bostic is definitely more on the dovish side. He's a little bit higher up here, I would say. But Bostic, saying in here, maybe let restrictive policy work for a while for the rest of the year. So slightly still sitting on the dovish side to sort of stay in pat, but certainly the rest of the FOMC. A lot of the FOMC looking for a more hawkish tone to come through. This was out in here this morning. Okay, so yesterday actually, US curve inversion deepens to 100. So after Powell spoke yesterday, the yield curve, I think 2's10s yield curve inverted through 100 basis points or hit 100 basis points as well, the 2's10s curve. Now we were wider than this previously, okay, in March of this year. But look, every time we've inverted in here, inversion here, recession, inversion here, recession. The red is recession, inversion here, recession. And this is going back to the 1980s, inversion, recession. So the March inversion wide through 100 was the most inverted it had been in here since the 1980s, and every time we've gone into recession and we're re-inverting, we're becoming more inverted again in here. Okay, so I'll just pop this one into the chat as well. Take a look at that if you do have access to Bloomberg. But that further inversion we've seen in here, the 2's10s curve inverting even further. And remember, I've got an explainer article now. I wrote this in here when we just started to invert. Basically this time last year. So you can see in here, I'm talking about what is currently happening with the US Treasury yield curve in Q1, Q2. So this is over a year old. I put this out, okay, as the yield curve just started to invert. This is an explainer. What is the yield curve? Why it's important? What does the inversion mean? What are bond yields? If you don't even know what bond yields are, this is a great little explainer going from what bond yields are, what is the yield curve in here, and what the inversion means for the market and why it means. Basically, it points to recession, okay? And we're re-inverting. It shows on here we've been at a wide of like something like 110 basis points on 2s 10s. It narrowed in again, but it's been re-inverting recently and hit a new inversion wide, the widest since March. And if it breaks the wide since March, it's the widest since the 1980s. And you can see every time we've inverted previously, every time there's been a recession. Actually, you got a little inversion here and it didn't, but every time pretty much it inverts, you would get a recession usually 12 to 18 months later. And we're now in that 12 to 18 month slot. We're right in that slot. So are we basically going into recession in the US? What else do I have for you? Stock slump as hawkish central banks sap spirit. So not just Powell, but also look, hawkish Fed precedes decisions in UK, Switzerland and Norway in here. The hawkishness in here weighing on markets. Futures inch low after Powell hints at more rate hikes to come. Oil falls from 4-week high on a hawkish interest rate outlook, not just from Powell, but obviously from the Bank of England now. And then we're seeing the yen rallying against the dollar, the yen rallying against the Swiss franc with that more hawkish tone. The yen and the Swiss franc seen as safe haven currencies in here, but the yen in here falling even against the safe haven currency of the Swiss franc in here. This is all to do with like the Swiss franc at a record high versus the yen. Swiss franc versus yen. So the Swiss franc going higher this morning in year as they hike to 1.75 in here, okay, as the Bank of Japan keeps this ultra loose policy. And dollar yen in here has moved to 7-month. So it's a low for the yen, a high for dollar yen. And if we look against the euro, it's a multi-decade high against the euro, I think. I don't see it against the euro. So dollar yen, where's the stuff up against the euro? I know. Oh, here it is. The euro yen as it is highest since 2008. So the yen is super weak. Why is the yen super weak? Because they're the only central bank who's not shifting to more hawkish. They're saying with that ultra dovish theme in here from the Bank of Japan. So the yen continues to weaken. And there is a lot of talk about, usually the Bank of Japan steps in, okay? Look, Japanese officials are closely watching the currency side. Usually they step in due to yen strength, okay, to weaken the yen when it's too strong. But in this scenario, there's talk about maybe, and I did have another article on here, but I don't think I've got it now. No, there is an article out there on what to watch for on intervention. We could see the BOJ, the Bank of Japan, intervene in the currency markets. They are prone to do that. Usually it's to stop the yen strengthening, but they could do it to stop the currency weakening further. So what's been going on this morning? Well, European bourses are significantly lower. The FTSE UK index is down over 1%, 1.15. The German DAX nearly 0.8, and the CAC, the French index, down 1.4%. And having dipped lower yesterday, US in exchanges down between 0.25 and 0.3 up to 0.4% lower in here this morning. So having looked for a potential, and then this continues to stick around this 75 to 80% level, the chances of a hike in here at the next meeting. But if we look out to December now, staying where we are now at 520. But the expectation is of a hike from 500 to 525 at the next meeting, right? Nearly, it's been between 75 and 80. And then we're looking for the market now, what we're 51, 65, 66%. There's only really in here, look, 29, 34%. So 34% chance of us going back lower in rates, 66% chance that we're either up 25 from here or more going into the end of the year. So the market's starting to take note. Another side, having had that rebound yesterday, slid lower to new lows, and then lower, look, down through that low in here. We're right on this 13-period exponential moving average. We hit that today, okay, the 13-period EMA. 43.92 it is at the moment, 43.92.93 for the ESU, okay. So a break below there would certainly be a negative. We're breaking below that impulse peak in here as well. Sorry, the impulse move low in here, okay. So that low there, 43.93.75. The low today, 43.93. So we're sitting right on that. We're sitting at a real critical level. If it takes out these two lows in here as well, 83.5 and 81.75, down through there, we could see a much deeper correction. So watching out for those today. And you know what? Having looked for a potential rebound yesterday, not looking for that at all now. In here, you can see the market rejecting this trend line in here. So the real risk is for a deeper correction. Any bounce back up into here towards 41.15, 41.20 area, I think is at sort of 41, 44, 44.15 to 44.20 area is a big sell zone in here for the S&P. And it's a similar story for the NASDAQ in here. You can see, look, poking below. We got right down to the 13-period exponential moving average. We're sitting right on that. That is currently at, in here, why is it not showing? Oh, it is 14,995. Okay, so we're down through that. We're also poking at this support here from back last week. The low there is 976, okay, with the low today at 970, and this low in here 963. Down through 963 now would be really negative in here for the Nasdaq. So can really looking to play this from the short side in here. So we've got this bigger trend line coming down through here. But any rebound, I think, into here, this area here, so 1580, 15100, there's your sell zone up into here for the Nasdaq. So still looking pretty negative. It looked like it was trying to rebound in here when we were on yesterday, but obviously a big slide after the cash market opened yesterday and stays a negative post-Powell. Tried to rebound post-Powell, but looking below. Why do you like the 13-period EMA versus the 9 or 21? Yeah, well, you know what? I switched over to using the 13. I just find it this is more on the daily, right? To be frank, on the daily, you can see in there so it's the same moving average in here. If I go to the 15-minute, and it's not really telling us anything here on the 15-minute, but on the dailies, it tends to work really well. When you break it and close below it, it tends to show the end of the trend, and it often bounces from it, right? So look, you get here, look, bounce, 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 and then once you break, that's the end of the trend. We go sideways, right? And then you can see in here, it kind of rallies from it here. We haven't really touched it in here, but generally speaking, we go and look at a lot of charts for the short-term trends. Look, you see it here. Look, we went and tested it here, poked below. Look, poked below, rebounded. So the 13 works particularly well. Remember as well, Jack 13. Why is it important? It's a Fibonacci number, okay? And that's why 21 is often used as well. 21's a fib number, okay? 13 plus 8. The one below would be 8 if you wanted to try 8 rather than 9 maybe. And a lot of defaults are 9 and 21. I mean, 21 is often used because it is another. So your Fibonacci numbers are 1, 1, 2, 3, 5, 8, 13, 21, etc., etc. Okay, so so 13 is a fib number as well. So I like that. That's why. Okay, and I've used it a lot of. We used to use it when I was at Credit Suisse. It was like the in-house default to use the 13-period exponential moving average. It works better on like when I say short-term charts, I mean daily charts, right? When on a daily chart, it works particularly well at identifying the trend. You can see here, look, it rebounded off here, and then in here, look, you come off it here. So it kind of defends that. And once you break it, you then tend to so you break it here, and it goes sideways for a while and slightly back down again. Okay. All right, guys, I'm going to wrap it up there. Any other questions? Good question, Jack. Any other questions? No. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back with you tomorrow for the final Bull versus Bear webinar of the week.